Hello and welcome. You're watching The Investing Edge. I'm Sumera Apti. The wealth management industry has grown rapidly over the last many years. And the idea behind The Investing Edge is to actually bring the learnings of these last many years so that retail investors like you can actually benefit from these learnings and from the knowledge and go out there and ask the right questions to your financial advisors. With me, as always, is Feroze Azeez, Deputy CEO of Anand Rathi Financial Services. Feroze, thanks so much for joining in for this episode in Chennai. And you know, the one question that we've been getting a lot these days is that on the one hand, the economic news has been negative, but on the other hand, the market just seems to be hitting highs. What do investors make of this dichotomy?
Economy is not doing well. Companies you go and meet, they say business acha nahi chal raha hai, business is not good, profits are not becoming higher, but still market is very high. Okay, why is that? And can it happen forever? How can it be that the company is not doing well, but the share price of the company is very well? Actually, no, there is enough headroom further because currently the market is high, but only 10 companies have done well. See, now market, let's simplify it. Market has one representative called Nifty. Nifty is 50 companies put together. It's called Nifty. Okay? Those 50 companies, out of those, the top 10 companies, prices have gone up significantly. I'm just saying top 10, there might be 8, 7. But the biggest companies of India have gone up significantly, is why the Nifty is high. But when you look at the stock prices of all the rest of the 3, 4, 5,000 stocks, they're not right up there. They're in fact 60, 70, 80% down from their peaks. Now, so in the same Nifty, when the other 40 actually rise, whenever so happens, there is still headroom. If all the 50 would have risen, then I would be worried. So, firstly, Nifty market is high on the back of 8, 10 businesses only, which is also scary at times, but that's one thing which we should know as investors. So there are advantages of it, there were disadvantages. This was already known that this will happen. Why is it happening? And will it continue to happen? Is because of April 2018 circular of SEBI, where most of the money which the poor India is contributing in the form of 1,000 rupees, 2,000 rupees a month in mutual fund is going only towards these top companies. That's why you see big companies quoting at very, very obscene prices. So will this continue? To my mind, it will continue because as long as India, poor Indian is contributing to the mutual fund will continue to buy these stocks and keep these up.
If I was to ask somebody today and say that, you know, devise a mutual fund portfolio, pretty much everything that they'd make is doing well, right? What is the kind of a portfolio which does well in, say, a year like what the last year has been? I mean, is there a mutual fund portfolio which can still generate some amount of alpha even in down times?
Yes, it can. When we're creating a mutual fund portfolio, our learning has been that you should not do anything flamboyant. Mutual fund, if you stuck to the simple products, generally people have the tendency to buy sectorial funds. Why don't I buy banking fund, pharmaceutical company fund, infrastructure fund? These are all sectorial funds. You should not buy them. People try and buy closed-ended funds, which lock in your money. It is provable with data that these are all bad for you. So if you know what not to do in the mutual fund, confusing mutual fund space of thousands of funds, then it is half job done. What not to do is the first filter you'll have to do. If I'm creating the portfolio of a mutual fund, first step is I will not go to the 40th AMC. I will stick to the top 10, top 15. Okay, for equity, I will choose different kinds of fund manager. For larger companies fund, see, you will have to write down the rules of the game before you actually draw up your portfolio. So I'm just giving you some illustrative rules. What is the illustrative rule? First, don't do fancy stuff on the mutual fund platform because data says you can buy a banking fund. If you bought a banking fund, last 1 year return is 18%. I am telling you exactly opposite. Why should you buy a banking fund? Because what will happen is you will buy a banking fund this year, you will be very happy, 18%. You will end up holding it for 4 years. You will come back to square one because there will be 2 years which it didn't do well. 3 years back, pharmaceutical fund did very well. So every advisor will say, sir, pharma is doing so well, let's buy that fund. You will also be attracted because you're looking at the rear view mirror. So whenever you don't buy sectorial funds, don't buy smaller AMCs generally, unless you have a very strong reason. Make sure that you have, you know what you're looking for in a fund manager. See, a fund manager who is buying bigger companies, he needs to know which sector to pick. A fund manager who's buying bigger companies, he needs to know which sector to pick. Car manufacturing company, banking, pharma, IT. The guy who's buying smaller companies needs to know to go understand that small company. So smaller mid-cap fund managers should know bottom-up stock picking. Large-cap fund managers should know top-down stock picking. So there are some rules you have to write down. There are so many such rules, but make sure that your advisor is using regression. Make sure he is using regression. You don't need to understand regression. You just have to scare him with this word. Are you using regression? Okay, you don't need to understand it. Regression is called statistical astrology, which does not only look at past, but has the potential to look at the future. Has the potential, not perfectly, but good potential to look at the future. If your advisor is only using past performance to recommend it to you, not using regression, then you're only looking at rear view mirror, not the windscreen to drive. You have to use one more Nobel Prize won formula, which we have been using for some time. That was one Nobel Prize to create a portfolio of mutual funds or stocks. It is called Markowitz theory. It's called Markowitz theory. Okay, Markowitz was the man who invented this. It helps you create 10,000, 20,000 portfolios and pick one for you mathematically. That model will tell you which is the best return for the lowest risk possible. So these are the first 8, 10 principles we wrote down and then chose these 8 mutual funds for our clients. I buy the same funds. I make my clients buy the same 8 funds. That's why whenever on any of your shows I bore you with the same 8 funds because they're good and they'll stand the test of time for the next 2-3 years at least.
Okay, the other thing, and you know, this is actually a query that we got from one of the past episodes, is somebody wanted to know, you know, for a new investor or somebody who's just getting started, should they start only with mutual funds? And I'll tell you why I asked this question, because generally in India, everybody's first investment is always an insurance policy. And that's because we have been thinking of insurance as investment. So for people who have, you know, large portfolios filled with different kinds of insurance policies that have lovely names, what can they do now?
Insurance is not an investment. Okay, see, anything which we do, after 10 years, 15 years, 20 years, we should take stock and check whether data is supporting what we've been doing. As in India, everybody will have an insurance policy. If you have dealt with a bank in India, otherwise you will have a relative who is an LIC agent who will come in obligation and you will give him a couple of lakhs or whatever that insurance. That's largely because insurance policies in India historically have had 70% commission. If you gave a 1 crore rupee check, 70 lakh rupee commission. Because you're going to pay 1 crore rupees every year for the next 10 years. So that's why it's going to be 70 times more lucrative than mutual fund. You can, so that's definitely, so that's one. If you've bought insurance policies for long periods of time, data says, 2000 insurance policies says that people have not even made 5-6% return after holding it for 10 years. Right? So should we stop doing that now? Because we have done it for 15 years, we should stop doing it because data says it was a wrong thing we were doing. It is okay to do wrong. It's the problem to continue to do wrong till we live. Right? It's about saying that, yeah, I went wrong, it's okay, it's human. But you have to correct. So don't ever take insurance policies as investment. Whatever name they give, child plan. You love the child so much, a child plan becomes very difficult to say no. Right? Because you're saying no to your child almost. Okay, his education. So people use these marketing lingo to make it more provoking to buy. So don't fall for that trap. Buy insurance. Buy term plans. Cover your life. Make sure that when you're not there, there is no financial trouble to the family. because emotionally they will go through huge trauma. Then you give financial trouble also, that's like very, very bad. I'm not saying don't insure your lives. I'm saying don't consider insurance as investments. Second, if you already have bought them, okay, don't think these are 15-year policies, so it requires no monitoring. Nobody monitors insurance policies. Right? The guy who made the commission, he's happy, it's already made. Next 20 years, he will not get any commission. So he says, well, how does it matter? Why will I monitor it? Mutual fund, everybody wants to monitor. When there is a 3% fall, next day phone calls will come. What do I do with this mission? Right? Insurance policy is also your money. Does it require attention? Rules have changed. Cost structure has changed. Even if you want to buy again, if you love some LIC agent, again you want to buy an investment-based insurance policy, at least buy the new one. The cost has come down to half. Remove the old one. So auditing. So I said so 8 years back, Anand Rathi banned investment-based insurance policies. It was a very tough decision. Okay, it's very easy to say, but it can impact my profits. So we banned it. So I can proudly say, no Anand Rathi private wealth, my division representative would have sold one investment-based insurance policy, in spite of its commission being 50 times more. So get it audited. So I have a division which says insurance audit, to exit, not to buy more. If it is already finished, so you should audit your insurance policy. All your policies, I have seen people who have 50 insurance policies. When you audit, you know that their 1.5 crore, 2 crores is languishing. If you just redeem that and put it in the right instrument, they will get 2 crores more in the next 4, 5, 6 years.
What about health insurance? Is that something that an HNI needs?
HNI needs health insurance for sure, because hospitalization is becoming more and more expensive. So buy health insurance. Today, health insurance is not investment. When you get hospitalized, you will get a 50 lakh rupee cover. If there is any critical illness, you have to be as generous as possible to save your life and your family's life. So getting and not impacting your portfolio is a good idea.
On that note, it's time for us to take a very quick break. We'll be right back, and up next, we'll open up the floor for questions from the audience. Do stay tuned in. Welcome back. You're watching The Investing Edge. We're in Chennai this week, and it's time now to open up the floor to questions from the audience. Yes, sir.
So my question is, what happens if the objective changes? Because as you know, life keeps changing. And then the objectives keep changing as we keep going through different events or different experience in life. So how do we manage a dynamic objective when a situation like that happens? Because all your strategy and everything changes based on your objective.
Opinions change faster, objectives change slower. Still, objectives will change. Like if you're a professional who are used to getting a salary, tomorrow you're going to be an entrepreneur where there's going to be inconsistency in income, the strategy has to be different. Because the objective is to get some consistency in return, probably from investments. If I was you, I would say, at least if I have accumulated enough money, at least half my salary should be credited through investments in my bank account, if I have accumulated. So how do you tax efficiently get that credit? Will require deliberation with your advisor. So what we do is, private banking is all about a full review of strategy once a year, if needed, and a monthly review. We do a monthly review with clients, which may not result in action every time, but a monthly review. So private banking does not have the problem, because there is such extensive engagement between the private banker and the client. So if objectives change, then you have to rework the mathematics and see how do you reallocate the money in such a fashion that you get at least half your salary. If I was you, I would expect half my salary to get credited, so that I can be secure when running an entrepreneurial enterprise, because I will need a very positive mind which is free from worry to run and make an entrepreneurial journey successful. So that will help me if I get a credit. So how do you reallocate it? How do you get tax efficiency? How do you use systematic withdrawal plans to get that consistent, to not pay 10 times the tax? All that has to be reworked.
Normally when we go for investment, this investment managers or what you call this, the consultant, they explain about the returns. Of course, more than the return, what is more important is how the capital is going to be protected. I think everybody will agree with me. So capital protection is the first priority than the returns. Okay. So they'd say that for all this AIF, whatever the money the AIF is investing on, various companies, they get the security of the money is ensured in a different way, like mortgaging their assets 3 to 4 times of, suppose it's 100 crores is given to a company, 300 or 400 crores is being mortgaged. And there is a, what you call the personal corporate guarantees, and then you have escrow account. So many things are being told up. So in spite of that, some AIF are reported loss, in the sense final exit, they are coming out and declaring the loss. Okay. That's first thing. Second thing is when they are paying out, some part is a capital repayment and some part is a profit, that is interest. But it so happened in one of the AF I have noticed, both these components have come out in the form of redemption of capital, and they are giving a letter saying that this is, you have to, as per some section, you have to pay tax for it. So when you are redeeming, the capital is as good as the capital is coming back. So there is no profit in that, but he says that capital redemption is considered as a profit and they are asking to pay the tax. And the third thing is the capital gain, you have to pay tax, the interest or OCD, whatever it is. But when there is a loss, it is retained with the AF. It is not passed on to the investors.
I would take as a learning that is it worth the complexity, right? Was it worth the complexity to generate? The AIF would have generated 10%, 11%. I am being generous. I don't know which AIF. At best, post-tax it wouldn't have generated more than 7, 8%. Was it worth going through such tax hassles, locking in your money, right? There are 3 types of AIFs. You've invested in AIF. What are the 3 types? You may not ever know because you have to do a full study, right? There are 3 types of AIF. For one of them, taxation is different. It is called pass-through. So if I have to buy AIF, I have to do one course first, 3 months course, right? Actually, what is pass-through? Now, your last part of the question was profits are not pass-through, losses are pass-through. So point I'm trying to make is, if I have a simple problem, in childhood my mom used to say, it's a simple problem, try and answer it in a simple solution. You're trying to add so many more steps, it is not needed. So my problem is simple, 14-15% is the return I wish to make. So if I have a simple problem, choose a simple solution. If I have a complex problem, if you came and told me, Feroze, I am generating 19% in my business. If I have to give money to you, you have to generate 23% at least. Then it's a complex problem. Then I come with a complex solution, or I tell you that, sir, you can never be my client, I'm not capable. Either way. So simple problems have simple solutions. Point 2, AIF. AIF, there are 3 types. AIF 2 has 69% of the 2.9 lakh crores as of latest. There is 2.9 lakh crore which has come into AIFs. Out of that 2 lakh crores approximately is in category 2, which is a locked-in category, 3-year locked-in. Okay? Category 3 and 2 are the important ones. Category 3 can do anything under the sun, more or less. Category 2 can do private equity and real estate. What you are speaking about is real estate NCD. Generally, you're lending to a developer 100 rupees. You're lending to a developer 100 rupees. He's giving you apartment worth 200 rupees as collateral, right? So mostly I would guess that you are in the category 2 AIF which you were referring to. Now see the complexity. Now you use the word mortgaged. There are 2 types of mortgage. English mortgage, American mortgage. The person who is selling you this product, he would not know what is English, what is American. Right? That's the unfortunate part. Even if it is mortgage, there is hypothecation, there is pledge. Or there is pari passu. So the point, why was I saying 3 months course? I'm just giving you illustrations. So point 1, if you have a collateral, why are they still declaring loss? In India, if you have an hypothecation with an American mortgage, it is as good as no collateral. Why? If there is a builder who is going bankrupt, let's assume I am the builder, you are the person whom I have given collateral to. I am going to go bankrupt in 1 month's time. Who knows it first, you or me? I will know it before you. You will read it in the newspaper. But I know that I'm going down under. So what will I do? I'll prepare to take a stay. Because it's a hypothecation, right? Real estate, you might want to sell the property. You have the collateral, you have the right, but it's an American mortgage. You will have to, if I take a stay, before you get to know that I'm going to go bankrupt, you will not be able to sell it for the next 10 years. I will give you an example. I bought a property in Bangalore 10 years back, 2009 exactly, March 10th. I bought it from SBI Bank in an auction under Surfacia Act. Still the case is running. Because the guy took fraudulently loan from Union Bank of India. I said he fraudulently took the loan. I participated in a bank's auction, a government bank. I legitimately bid for it. I was the highest bidder. I paid the money. I took the property. The property still has a lien mark. So I might have collateral, but if I have to go through 10 years of wanting to go through this legal battle, it is unbelievable how much time it can take. So all these collaterals are just comforts. But if there are escrow accounts, now you might have escrow account is one more thing. Escrow account is money will go into a bank account. Escrow accounts are very good mechanisms to protect yourself, provided the apartment is being sold. If there is no sale in the apartment today I might have, builder has 1,000 apartments. The escrow account will only be given credit if those 1,000 apartments are sold. Otherwise the escrow account has zero money in it. No? Today, there are builders in Bombay who have 3,000 apartments to sell. They're selling 2 per month. So how many years will it take to sell those 3,000 apartments? So escrow account will not get the credit at all. So escrow account is very good if the real estate market was doing well. Collateral is very good if you have taken an English mortgage. It's very expensive to take an English mortgage. Then you don't need any court's permission to sell that property.
I would like to seek your guidelines on the investment for retired people. I have 4 objectives as to put it. First thing, I don't want to erode my capital in this process. Second, it has to beat my inflation, and I have to keep reserve for my future also, and to have a regular income, and to minimize the tax implication.
See, first, if you're going to be planning your retirement, what is the first variable logically we need to know? How long will you live? Right? Which none of us know, right? To plan retirement without knowing what is my life expectancy is very tough. So what we did was, we found out the actuary data of India. Matlab, I would ask you your health habits. And India may, whoever is no more, there is data of them. 1 crore people who died. What was the average life they lived? The average life expectancy could be 82 years, for example, depending on your lifestyle. So then I know if you are at 55, you have 27 years to live. Without knowing how long will you live, retirement planning is not possible. I don't know how are people doing retirement planning without actuary data. Second is, you said there are 2 objectives, protect your capital and beat inflation. Unfortunately, these are counterintuitive objectives. When you're desperate to protect your capital, beating inflation becomes tough. So protecting your capital on a 3-year basis, on 3 years, I should never lose money on a 3-year rolling basis. That is possible. Now how do you do it? Okay, so inflation and return don't go hand in hand. So point I'm trying to make is, can you design a strategy which can actually have a return objective and a risk objective which is different. So what I would do if I was you is, I would break my corpus into 2 portions. One, which I will consume in the next 6-7 years. There I will not compromise on 1 day negative return also. The rest of it I know will stand the test of 6 years. So there my investment strategy will be very different. So that portion's job is to generate and beat inflation big time. The portion of this job is to make sure 6 years I don't need to dip into this capital, right? So strategy for a retired person will need deliberation and that private discussion depending on the context you come from, sir.
Feroze, thanks so much for joining in for this episode of The Investing Edge. With that, we'll wrap up on this episode. Do stay tuned in to CNBC TV 18.